Disney will report results on Thursday of this week. Typically, in our earnings preview videos, we compare management's guidance to the consensus estimates. Unfortunately, Disney's outlook is very limited, with just 3 data points of guidance, which isn't much for a company with 6 operating segments. As a result, we cannot go through our full scope of guidance analysis. However, management has given some insight on what we consider is the most important segment for shares this quarter, and that is operating income for the cable networks business. Before we get into that, let's go through a quick breakdown of the earnings model that we'll be using for this analysis. The format is similar to our other companies. In the upper left-hand corner, we have our price earnings multiple and DCF-based valuation summaries. That's followed by the income statement, which for Disney is primarily modeled on a GAAP basis. They have had some non-GAAP adjustments in the past, but they've been pretty much minimal relative to overall earnings. The model is calibrated to meet consensus estimates for top-line revenue and bottom-line EPS, and it's color-coded, so you can see anywhere that you find an orange cell, those represent consensus estimates, blue cells represent our estimates, and purple cells represent company guidance. So as you can see, there's not a whole lot of guidance in here. So below the income statement, we have our segment details, and we model Disney for all 6 of their primary segments. You can look at cable networks first. For each segment, we have a revenue growth rate, then we have an operating income margin, which is how we derive the operating expenses, and we also have estimates for capital expenditures by segment. Each segment is similar, but then below the final segment you have some profitability and expense ratios, and then we have an analysis of share count changes and a summary of the non-GAAP adjustments for the periods that they had them. Below that we have the full balance sheet and cash flow statement, and that's followed by our multiple valuation summary and our discounted cash flow valuation summary. So now we can scroll back up to the top, the income statement, and get into management's guidance. So if we go back to the guidance they provided, this is available on their investor relations page, and you can scroll down to page 7, which is where their outlook begins, and we've highlighted a couple of the key items. So the first one that they note is that the strength of the US dollar is going to have a $500 million adverse impact on their total operating income, and that is up from the prior quarter, the third quarter of this year, the third fiscal quarter of this year, where they had estimated a $225 million impact. So that was a big news item last quarter, but now that our model is calibrated to consensus estimates, it's already included in each one of the segments, so there's nothing else that we need to do in terms of calibrating our model to meet guidance for this quarter. But if they do increase this estimate, we'll have to bring our operating income by segment down just a bit. So that's one thing we'll be watching for this quarter. Next, they guided the 2016 share repurchases to be between $6 billion and $8 billion. So if we go back to our model, obviously it's difficult to say exactly how many shares will be retired by this program, because we don't know what the repurchase price is, but in our model we've estimated a price of $115 right now, and we'll change that as the fiscal 2016 year proceeds. But for right now, we're assuming $115 price, and we're assuming $1.75 billion per quarter, which gets us to the midpoint of that range of $6 billion to $8 billion, and that means they'll retire approximately 61 million shares over the fiscal year 2016. The final piece of guidance management gave was the cable network's operating income growth rate, which is expected to be in the range of the mid-single digits from the period of fiscal year 2013 through 2016. So if we scroll to our segment details and expand the cable network segment, you can see that we have basically set the midpoint of that range at a 5% growth rate from 2013, and that's on total cable networks operating income. We believe that this is one of the key points that will be discussed on this quarter's call as investors continue to watch for trends of cable cord cutting for low-cost web-based program alternatives. Other than the cable network results, investors will also likely be looking for insight on the latest Star Wars release in December, as well as the progress on the Shanghai Disney Resort, which is set to open in the spring of 2016. And if you'd like to tweak some of our assumptions for those two events or any other events in any of the other segments, feel free to download our model. It's available for free on our website. If you click on the free models tab, there'll be a short registration, and then you'll have access to all of our models, so you can scroll down to the bottom of the page where you'll find Walt Disney brands and just click this button to download. And if you disagree with any of the assumptions in our model, you feel free to post your own on our website and we'll make it available for our users. Be sure to check back with us after the earnings call when we update our model for the latest results, and please subscribe to our YouTube channel and share this video with your friends. Thanks for watching and good luck with the release.